Welcome back to The Explainer. I am absolutely thrilled you're here with us today. So, we're putting on our senior macro strategist hats and doing a deep dive into a company sitting right at the absolute center of the modern defense spending cycle. Yep, we're talking about Lockheed Martin. Now, if you follow defense markets at all, or honestly, even if you just skim the news, you might naturally assume that the second geopolitical escalation happens, it instantly translates into cold, hard cash for the big defense primes. I mean, the headline logic seems totally straightforward, right? But today, we're going to use the hard data to completely dismantle that market assumption. We are going to dig into the massive gap between threat perception and actual intrinsic valuation and figure out how to read the real story here. I really want you to burn this core concept into your memory. Geopolitical conflict creates demand, but factories create revenue. You know, delivering on defense contracts isn't like a software update you can just push to the cloud overnight. This is heavy industry. It's wildly complex engineering, it's physical reality. And a lot of defense investors just kind of stop at step one. They see conflict, they see missile depletion or rearmament, and they immediately assume the revenue just automatically and instantly spikes. But honestly, that's a headline-driven illusion. The reality of Lockheed Martin's value actually hinges on a long, complex, and very physical chain of execution. Okay, so here is our roadmap for today. We're breaking this explainer down into four critical layers. First, the geopolitical budget tailwind. Second, the real earnings test. Third, capacity meets core franchises. And finally, we'll build an intrinsic valuation framework. Let's jump right in.
Starting off with Layer 1, the geopolitical budget tailwind. $1.01 trillion. Yeah, trillion with a T. This is the U.S. fiscal 2026 national defense budget request. We're talking about a 13.4% increase from fiscal 2025. That breaks down to $848.3 billion for the discretionary budget, plus another $113.3 billion in mandatory funding. I mean, that is just an enormous expansion of the overall demand pool, and it is being shaped entirely by global threat perception and geopolitical urgency.
And the thing is, this isn't just a U.S. story. When we actually break down the macro demand drivers, we definitely see U.S. priorities focusing heavily on Indo-Pacific deterrence, munitions production, and nuclear modernization. But it's also about NATO allies. They've made a 2025 commitment to invest 5% of their GDP annually on defense by 2035. That's 3.5% for core military and 1.5% for broader security. Impartially speaking, these global priorities plug directly into Lockheed Martin's core portfolio. Advanced systems like the F-35, missile defense, and command and control networks, these aren't just domestic assets anymore. They have massive allied relevance. So the top-line demand, it is undeniably there. Which brings us to Layer 2, the real earnings test. $186.4 billion. That staggering figure right there is Lockheed Martin's total backlog as of the first quarter of 2026. To put that into perspective for a second, that is roughly 2.6 times the company's annualized sales. It is an absolute mountain of awarded future work. But, and this is probably the most critical lesson of this entire explainer, backlog is not cash in the bank. It represents potential. It's essentially an authorization to build, not a cleared check. Now let this sink in. Contrast that $186 billion backlog with this figure, negative $291 million. That was Lockheed Martin's actual free cash flow in Q1 of 2026. Wait, what? How is that paradox even possible in the middle of a booming defense environment? Well, it's because defense revenue is not linear quarter by quarter. Working capital gets tied up, milestone payments fluctuate, production schedules shift around. Now, to be fair, management did reaffirm their full-year guidance of $6.5 to $6.8 billion in free cash flow, so the cash is eventually coming. But this negative quarter one figure perfectly proves our thesis. Demand does not equal instant cash. To really wrap our heads around why, we need to walk through this contract-to-cash flywheel. Geopolitical escalation raises the demand curve, absolutely, but it doesn't just magically erase the execution curve. Step 1, threats drive budgets. Step 2, those programs actually have to get funded by the government. Step 3, the company wins the award and it gets added to that massive backlog we just talked about. But then we hit Step 4, production and supply chain. The company has to actually go out and source rare earths, microelectronics, and skilled labor. Only after they build the thing, pass quality checks, and deliver it in Step 5 do they finally reach Step 6, free cash flow. This is the lag. This is the friction in the machine. And when we slice open that $186 billion backlog, you can see exactly where that future work is sitting.
Aeronautics is leading the pack at $55 billion, heavily driven by the massive centrality of the F-35 program. But right behind it, missiles and fire control is sitting at $46.6 billion, followed closely by rotary and mission systems, and space at $39 billion. This tells us this isn't just an airplane company. They're deeply, deeply embedded in the absolute most critical, high-demand sectors of modern deterrence. So, if there is one single term you take away from this section, make it backlog conversion. It's the ability to turn that mountain of awarded future work into executable production, actual revenue margins, and ultimately, free cash flow. As an investor or a market watcher, you always have to ask yourself, is the backlog funded? Is it profitable? And crucially, is it actually executable given today's massive labor and supply chain bottlenecks? All right, moving into layer 3. Capacity meets core franchises. Let's look at the key engines actually driving this machine. Aeronautics gives us the F-35, which isn't just a production program, it's a multi-decade sustainment franchise. But honestly, the cleanest signal here is Missiles and Fire Control, or MFC. Their Q1 sales were up 8% year over year to $3.65 billion. Why? Because MFC is the segment that produces the PAC-3, THAAD, and precision strike missiles. This is tied directly to the urgent real-world demand for munitions, air defense depletion, and allied rearmament. When global inventories run low, this is the exact engine that gets fired up. But remember that execution curve we talked about? If demand surges, you need the physical factories to match it. And here's how Lockheed is adapting to that. They've signed multi-year agreements that act as a massive capacity multiplier. They are literally accelerating advanced Patriot, THAAD, and present production to 3 to 4 times their current rates. And why this matters is super simple. In a high-conflict world, the market is valuing speed of replenishment almost as much as the underlying technology itself. You have to be able to build it, and you have to build it fast. Which brings us to our final layer, intrinsic valuation framework. So here is the whole point of this explainer. There's a wrong way to look at this, where Wall Street often just assumes geopolitical risk equals instant earnings, or conversely, they treat the company like some static, low-growth bond proxy and totally ignore the backlog cycle. The better framework, the smarter way, is valuing Lockheed Martin fundamentally as a backlog conversion and capacity story. You really have to view it as an F-35 sustainment franchise and a cash flow compounder. Risk creates the demand, absolutely, but execution is what creates the earnings. And look, we have to impartially acknowledge the friction in that execution. Turning a $1.01 trillion macro budget into intrinsic value is absolutely fraught with hurdles. You've got budget politics in Washington that can easily delay funding. You have severe supply chain constraints, literally just getting your hands on the rare earths, the propulsion systems, the microelectronics. There's the risk of cost overruns on fixed-price contracts. You've got volatility in how many F-35s are actually procured from year to year, plus broad geopolitical and ESG scrutiny. These are the very real physical and political realities standing right between a signed contract and a realized profit margin. Which brings us to the ultimate question you've got to ask yourself when you're analyzing this entire space. How much of today's geopolitical urgency becomes funded, executable backlog that actually converts into free cash flow? That right there is the true bridge between the flashy news headlines and the intrinsic value of the company. Because at the end of the day, it's not just about what the world needs. It is about what can actually be built, delivered, and converted into cash. Keep that question in mind every single time you look at the defense sector. Thank you so much for joining me on this explainer today. Keep learning, stay focused out there, and I will see you next time.